Welcome back, friends, to Alpha Beta Soup. I'm TXMC. Well, we've got a few things to discuss today. We'll look at the Bitcoin price chart. We'll also take a peek at what equities have been up to. We'll talk about the yield curve and what it means for possible recession coming up. Then we'll also dip our toes into some on-chain. I'll show you what the long-term holders have been doing and an observation I made about exchange flows. So don't miss that. You're tuned in to the best Bitcoin and on-chain analysis channel on YouTube. If you enjoy this content, make sure to give my video a thumbs up and subscribe to the channel. We've got a lot of things to talk about, so I'll keep this intro tight. Let's get to it. And price action has looked pretty good the last few days, though we are slowing down here in this region. And we'll talk about where I think we might go next. So now that we've reclaimed the yearly open, which to me was a significant place to get back to, I mean, it had provided such consistent resistance ever since we got down below this level that getting back over this was the first challenge to surmount. And the way that price just ripped through this little area right here, it was nice to see this kind of strength. After multiple attempts to see candles close in this region, as we've talked about in previous videos, we saw the price action just blitz through this whole zone right here, which was impressive strength, but it has since slowed down at what was previously the 2022 high, that we've now set a new slightly higher high over here. And I think it's reasonable to expect a couple of days of gathering here before we break back out into a direction. So what would that direction be? Well, most folks would expect and hope that it would go up. I think right now it's hard to fight that trend. I do think we're locked into the beginning of what I expect is a retrace rally, but we'll take it a step at a time. And the next level up in terms of resistance is kind of up in this area here around 52,000. If I had to kind of draw something out, I would say this looks like the next kind of area for price to wander up into. So what we may get over the next couple of days is kind of chopping around in here. Maybe it flashes below and then we kind of work our way back up. That's my base case expectation, but I don't even know if this would be a breakout or just become a new range. There was a lot of volume transacted in this area right here, so I expect some churn as we work our way back up to 50K, which is right around right here. Zoom out my chart here a bit and we put our volume profile back on that we were looking at in the previous video. I'm going to corral it to just being 2021 volume to now. And what we see, which we talked about last time, was this empty pocket of lower volume right here between 44 and 46,000, where not a lot of supply had changed hands in the past calendar year as we've been bouncing around in this big macro range. So it didn't surprise me in the least that price action just blitzed straight through, because there just showed that there hadn't been a lot of psychological importance placed on those prices by market participants. So we just lasered right through it. But as we can see, we have now entered a zone of higher volume, right? If you look here at this zone that I just boxed out for you, I'll put a little line around it so it's easier to see. This is higher volume. There's more churn here. And it's because of how much time price has taken to get out of this range in the last year or so. It's spent a lot of time here. So that's feeding into my general base expectation that it'll take us some time to get through this area. I think that's a reasonable expectation, especially after we waited so long to break over this level. And I think that a slow zipper climb like this up to the next resistance area in the middle low 50s would be better to see and probably more sustainable from a rally perspective than if price just did like a double pump straight up. That would leave a lot of investors behind. It would be very FOMO inducing, and we would probably have higher risk to the downside from profit takers looking to cash in on the low liquidity provided by that pump. So right now, base case expectation from price is I'm thinking we will probably spend a couple of days down in this area before beginning kind of a slower chop climb up to 50 and 52. That's what I'm looking for, at least. I think expecting a little slowdown in price makes sense when you look at the market picture broadly. So Bitcoin, the S&P 500, the Dow Jones, and the NASDAQ are all currently competing with their 200-day moving averages. The S&P's already found a way back over it, but everything else is battling with it as we sit here now today. And for the past couple of weeks since we hit the lows, equities have just been on a straight rocket ship mission upwards. So I do think it's reasonable, especially now that we've started to set higher highs on the daily charts for these indices, I think it makes sense that we might see a back test of these levels, and that could portend a slowdown in the rally. I think that's a reasonable expectation. I don't have a lot of extra alpha to suggest to me that equities are going to pull back, but just from a price structure perspective and from the trend we've been following, things tend not to go in a straight line for too long, and I think we're bound to see a little bit of a pullback over the next day or two. That's what I'm thinking right now. Part of that has to do, honestly, with the damn near inversion of the 2s, 10s yield curve. This has been an extremely reliable signal about an impending recession going back through US history. Let me show you what I'm talking about. Okay, so what we're looking at here, just to quickly make this point about the yield curve, we're looking at the S&P 500 at the top, and these highlighted bands are recessions. That's periods where the US markets experienced consecutive quarters of negative growth, and that data is taken directly from the Federal Reserve data pumped into TradingView. Down here at the bottom, we've got the yield curve in orange. That's the spread between the 2-year Treasury yield and the 10-year Treasury yield. Short-term interest rates and long-term interest rates. And when this indicator dips below 0, as you can see in these blue highlighted bands, it indicates that the 2-year yield has surpassed the 10-year yield in the Treasury yield curve. And what that's saying is that shorter term interest rates are higher than longer term interest rates. That's usually a sign of an inefficient market and of trouble brewing under the surface. Typically, as an investor in any market, you would expect that for taking on risk for a longer period of time, you would stand to gain a higher reward. That's the essential logical function of markets and of store value. Well, when you get an inversion of the yield curve, when you have 2-year rates higher than longer term 10-year rates, it's signaling lower growth expectations and higher risk in the short term. Now, when you look back through history, times when the yield curve of the 10s and 2s has inverted have come before recessions. Note how the blue tends to come before a period of red, and it's happened every time. And in fact, if I go zoom in a bit over here, we got an inversion in late 2019 before we ever found out about COVID-19 and got the recession as a result of that. It's been extremely accurate at predicting recessions because as a natural function of markets, it's backwards for short rates to have a higher yield than longer rates. So for this to become inverted means there are inefficiencies boiling under the surface. Now, the reason I bring all of this up is because we're seeing the markets rally in the face of an impending recession signal out of the bond markets. When we look back at the last several times the yield curve has inverted, the market was moving up during those times. There was still confidence going on in the markets. But we know by looking at history that all of these instances have resulted in severe downside within 6 to 18 months after the inversion of the yield curve. So right now we're seeing a rally after a very strong correction in the early part of the year. But what's got me concerned and what's got traditional market investors concerned is this inversion right here and what it portends about the next half year to year of market action. I think it's incredibly likely at this point, when we think about the cost of commodities, when we see oil bouncing around over $100 a barrel and not yet showing signs of weakness, I think it's fair to be apprehensive about the long-term prospects of the rally we're seeing now in equities. How high can these things go? Can they make new highs in the face of an impending recession? Will the markets care? Or will it be a race to gather as much yield as humanly possible before the wheels come off? That's a question I'm trying to answer for myself right now. And I don't have a clear signal on what I think is going to happen. But coming into this year, my general base case was that Bitcoin would find it difficult to make new all-time highs in the current macro climate. We have a tightening schedule coming on in the Federal Reserve. They just began their rate hikes into a period of slowing growth, and we're now looking at a possible recession signal with the inversion of the bond yields at a period of extremely high energy and commodity prices. There is a storm brewing under the surface, and this bullish price action here in equities is running counter to those very real concerns. So when we take all of those risks into consideration, I think it's fair to be apprehensive about this upside that we're seeing here, about how high we think it can go in the current climate, when the market is flashing major red flags at us. Now, for many Bitcoiners that I talk to, it seems like their confidence stems from a belief in the narrative that Bitcoin will decouple from an otherwise unwinding global market. And while I see a potential pathway for that, a non-zero percentage chance that it could happen, I can't base my realistic market thesis on an outcome that hasn't come to pass before. Bitcoin has followed the markets since inception, and we've been in a secular bull market for a decade now. Crypto broadly, not just Bitcoin, has yet to experience a true market downturn, a pullback in growth. And I think that we are heading for that in the relatively near future, and I'm uncertain what it will look like for risk assets. My gut is that it will not do well for them. Bitcoin is the premier risk asset in the minds of average investors. So that's what I have to consider. I have to put my personal feelings about it aside and think about what the market will do, how the market will perceive Bitcoin, and the actions playing out on the global stage. That's what will determine price action. So that was a long-winded way of saying that we're seeing strength here in the face of very real concerns about the market's health over the next year or two. And I just want to instill some caution in you, my friends and viewers, that sentiment has become extremely bullish in a very quick amount of time, which is what we've talked about on this channel happening to Bitcoin as it creeps back up to 50K and ultimately breaks back over it during a relief rally. We're starting to see those things play out. We're starting to see those conditions coming to light. I mean, just look at the fear and greed index. A month ago, we were in extreme fear, and we're now back up into greed. If we look at it over time, throw it on here for the last year, the greed index is now back up to middle November levels. We have leapt across the entire low confidence era that we've experienced since November 18th. It took very little time for market confidence to go right back up to the bullish side. And that is where I get concerned. That's where I feel like market fragility is at its most vulnerable point. And it's something that I want to be cautious of as we move forward into the next couple of levels of price action. Now, dipping into the on-chain space, what we're looking at here is long-term holder spending. It's been a while since we've talked about long-term holders. For those who are unfamiliar, this represents the amount of Bitcoin that is held by users who haven't moved those coins in 5 or 6 months and longer. Based on the analysis of 13 years of ledger history, Bitcoin tends to be spent at a lower frequency the longer it is held. And once it reaches about 5 or 6 months of maturity, the true cutoff is about 155 days. But roughly 5 or 6 months after that point, the chances of them being spent drop significantly. And what we do over time is watch the supply held by long-term holders as it oscillates in and out of market cycles. This group tends to spend coins to distribute into market strength as we break new highs, and then accumulate on the backside into the bearish periods of markets between the peaks. So I've explained that here. Let's take in this visualization. At the top, we've got the price chart. This blue band here represents long-term holders. This cutoff right here where it goes from blue to white is the hard cutoff for what we consider a long-term holder. Now at Glassnode, their actual function for putting supply into long-term holder doesn't do a hard cutoff. It's kind of a smoothing function over 150 to 200 days, but the actual median cutoff is right here. So you can see that the newer members of the long-term holder group acquired their coins in the recent bull run. So these are folks that have experienced almost no upside since entering their positions. And what we can see at the bottom here are a couple of different data points about long-term holders. In the background in gray is their raw supply. You can see it climbs here. It begins distributing, begins losing ground as we creep up towards the previous all-time high, which was right here in the middle of the screen, right around this point. This was the 2018 all-time high. We came up, we curled under it for a few days, and then we broke above. And this period was when long-term holders were dispensing coins. Now the two lines in the middle, the blue line is their unrealized profit. So it's the profit ratio of all of the dormant Bitcoin that sits in the long-term holder group from all the way back to inception. The red line is their spending. It's the actual coins being moved around and transacted, spent into new hands. And both of these are profit ratios. So what you can see just by looking at the relationship of the two lines is that the dormant supply tends to always, predominantly always, have a higher standing profit ratio than the outputting of coins. The spending of coins tend not to be the most profitable ones. And in a lot of ways, that's because older and older coins have a lower likelihood of being spent. So coins that are in extremely high levels of profit from 2016, 2015, 2012, those are not moving with any notable measurability in today's market. And they're sitting in very high profit. So it helps to create this cushion between what is being held and what is being spent. The reason I want to really talk about this today is for a couple of data points. The first one is right over here. If you notice, long-term holder supply was growing aggressively even through the rally up to all-time highs. This is showing that a massive amount of supply that was churned through the bull run coming into 2021 was sitting dormant and aging across this threshold, this 155-day cutoff, as it moved through the supply as time passes. More and more coins graduating into long-term holder supply. Well, this value reached a peak right around the all-time high. Right around here, this is the point when long-term holder supply reached its apex. And we did see spending out of this group. This is normal. It's what you would expect. It's the same kind of activity we saw right back here. Granted, much more muted. You notice the aggressiveness of outflows. The change in supply here is just a fraction of what it was in late 2020. That's an interesting observation. But taking that a step further, what we've seen is continued spending out of this group. Now, normally long-term holder supply, when long-term holders are not spending, it tends to kind of gravitate upwards because a coin's natural state is to sit dormant and age. It requires action. You have to make a decision and transact with a coin to change that normal behavior, to make it lose age. And so we know there's a lot of supply every day that's sitting dormant and growing older and becoming part of long-term holder supply. Yet, their supply is not continuing to grow anymore. And in fact, its highest point was right here between the two all-time highs. That was the highest point of long-term holder supply. And since then, it's been kind of chopping around. It's reduced a bit. And I did some calculation, and this is about 0.1% of their supply that has been lost out of this group. It's a very small amount. But the point I'm really getting at here is that long-term holders have been spending during this entire downturn, which is not a typical behavior. A lot of times when we see downturns like this, we're seeing growth in long-term holder supply, a net gain, as maturation of coins is far outweighing any spending out of this group. But over here, we're actually seeing a softening and a net outflow of long-term holder supply. Granted, it is small. It's not like this massive change that we saw here a year ago. But nonetheless, their spending is mitigating any new growth in ownership for long-term holders. So it seems that this group is a bit softer. They aren't quite as strong-handed and convicted as they were when we reached all-time highs a year ago. This market and the subsequent bear in May, June, and July showed normal long-term holder behavior. But we're seeing a softening over here. They haven't shown the same kind of HODLer conviction. And when I look at their ratio of spending, which is this red line, it is in a long-term structural downtrend, meaning the spent profitability for long-term holders is getting lower. Now that makes sense, right? Because we've spent a year ranging in this zone here between 30 and 60,000. There hasn't been a lot of new gains. So people who are maturing into long-term holder supply with coins from 30, 40, 50, 60,000, their profit ratios are not nearly as high as people who have been hodling since March 2020 or since before. So when we look at long-term holder supply, we can see that broadly as a group, they still have an unrealized profit level of almost 3. Their spending profit has been declining, which to me signals that this spending right here, this weak spending, is predominantly coming from from newer members of long-term holder supply with lower profit ratios. Their cost basis is closer to the current price, and they most likely acquired their Bitcoin within the past calendar year. They haven't had as much time to build conviction. They haven't weathered a full market cycle like some of our older hodlers have. And this group, these members of this cohort, may provide additional overhead supply if price begins creeping back up and showing more strength. I want to see long-term holder conviction holding up. I don't want to see additional spending, and I don't want to see their realized profit climbing, which would indicate people from the distant past relinquishing their coins out of fear of future weakness. We don't want those dynamics to play out. The last thing I want to touch on today relates to exchange flows. So we've looked at this chart before. This is the 90-day change in exchange flows, and it's colored by the 90-day change in price. This period from May to July, as we've spoken about on the channel before, was a period of heavy inflows to exchanges. These are coins deposited onto exchanges for presumed sale at a time when price was extremely negative, shown with a dark red color. In the last few months, we've been seeing net outflows to exchanges in the face of price weakness. You can see a huge difference in the behavior of exchange flows now compared to the 50% correction of last year. And the reason I want to look at this is because of this chart. This is showing you the total volume in and out of exchanges by price. So down at the bottom, I've got prices from 29K all the way up to 67K. And this is the volume in and out of exchanges from January 1st of 2021 to now. Now what we've got at the bottom is total volume. Total volume in and total volume out combined for exchanges. The colors represent dominance. So a red bar indicates that in that zone, there was more inflow volume than outflow volume. There was more coin deposited onto exchanges than withdrawn from exchanges. That's what a red bar means. A blue bar, as indicated down here, is outflows. That means that here, for example, at 33K, there was a higher volume of coins being removed from exchanges, right? So at the bottom, we've got the sum volume, and at the top is the actual delta itself. So you can see the dramatic difference between inflows and outflows in that price point. So the reason I want to bring this up, and let me first preface this by showing the price chart. So right now, as I pointed out, we're around 47,000, which, as we discussed, is a place of high volume over the last year of traded volume on Coinbase, right? This is actual transacted Bitcoin on the Coinbase spot exchange, right? And where we are here between 46 and 48,000 is a high volume node. When we go look at exchange volumes by price, where we are right now in current price action is right here, which curiously happens to be one of the highest points of the whole year for exchange volumes. Not only is it a high point for traded volume on Coinbase, it's also one of the highest points of the past year and change of exchange volumes. And it happens to be a place of dominant exchange outflows. These are people withdrawing Bitcoin from exchanges. A heavy surge of outflows occurred in the current zone of price from 46 to 48K. I find that pretty interesting. And I think it's something that may play a factor here, that we're in a place both in the center of the yearly price action, but also at a point, an apex of trading volume and an apex of exchange volume, particularly outflows. So I find that to be pretty curious, and I will be watching exchange flows as we go on here. I don't want to see this trend reverse and us start to see a bunch of inflows. We're not seeing that right now, so no concern, but I thought it was pretty cool that we're right in the middle of high outflow volume. So we're at a critical point for price. We're in the middle of high historical exchange volumes. We are in the middle of high trading volumes. And we also are in the center of a yearly range of price action. We're right in the middle, friends. And this comes on the back of Bitcoin being 45% up from the lows, 43%. And there are a lot of investors who have been sidelined for this entire move that are just now becoming bullish again. They waited until Bitcoin was up 45% off the lows to decide that they were flipping bullish. Those people do not have good risk reward. So if we get any weakness at all in the next few days, if we start to see dips down here, watch out, because it could be violent if there has been any FOMO going on so far in this rally. People who ignored all of the opportunities to buy below 40,000, finding price now at 45 and smashing buy, those people are not highly convicted, and there's a good chance several of them have entered the market here. But as we talked about from a price action perspective, I think we'll chop around in here a little bit, maybe flash below, and then start working our way up towards 50.52. I think there's a good amount of churn for us to experience in this region here, and what I don't want to see, ideally, is a softening, an additional softening of the spending out of longer-term Bitcoin holders. They haven't been as strong of a floor as we've looked for in the past, and we do need their conviction to hold up for this market not to roll over on its own face. Price action is constructive. We've rallied off the lows, equities are looking strong, but I think we're entering a place where we might get a pullback. For the next couple of days, it'll be key to watch how severe that is, or whether or not we see additional bids stepping in and forcing more strength. But what we don't want is an additional weakness out of the longer term holders. Make sure you're following me here on Twitter at TXMC Trades. This is where I post a lot of my charts and analysis, and it's a great place to interact with me. If you have any questions or comments about what we talked about today, leave them down below and I will be sure to read through them. It's a beautiful day here in Texas, so I think I'm going to wrap this up and go spend some time outside. It's good to get away from the charts for a couple of days and let my mind decompress. I think today's a good day for that. So we'll talk again in a couple of days. In the meantime, take care of yourselves, friends. Be kind to one another. We will chat again very soon. Cheers.